Welcome to my channel. Today I want to give you guys an idea of what I plan on buying in March of 2022. And I want to provide a little bit of an update on my performance of my portfolio because it's been pretty volatile with the Russia-Ukraine conflict. Of course, we have inflation that's gone sky high and rate hikes that are planned. There's a lot going on. And so I really think this is creating a very unique and rare opportunity for investors to buy good companies at very low valuations. And so you have to analyze the market and deem what you feel is a good buy. So what I'm going to present today are good buys that I plan on doing in March. And if you're new to this channel, I invite you to subscribe. It's free. Not a lot of things are free these days. I provide a good, perspective on things, quality content, my strategies, and I'm transparent. The good and the bad, I share it all with my portfolio. And that's what we'll kick it off with. So be sure to subscribe. So my portfolio at the end of 2021 was at a 23% growth. Since then, about 2 weeks ago, it was down to 9%, quite a big fall. Then last week it was up to 11%, but it's fallen back down to 9%. Of course, the volatility is it's there. The main reason for my portfolio dropping is I bought a lot of Facebook before it dropped, before it had its crash. So I'm averaging down right now. And I have a few other companies that have gone decently in the red, and I made a video on that, so be sure to look for that in my channel. I revealed the 3 companies that have crashed that I have in my portfolio and why they did, if I'm holding, if I'm selling, what I'm doing with those. But 9%. If my portfolio goes in the red, I am not going to change anything, right? Unless if the fundamentals of a company that I've bought have changed, something that made me buy into it, if something changes that I feel no longer do I believe in, that's when I would sell. But right now, whether my portfolio is in the green or the red, it doesn't matter to me. I'll keep buying. And in times like this, I think there's opportunities to buy things on a huge sell. So we're going to go into holdings, companies that I plan on buying now in March of 2022. So we're going to kick it off with a very new company that I bought, a very new stock, and that's T. Rowe Price. Now, T. Rowe Price is an investment management company. They deal a lot with mutual funds, retirement funds for private companies that they manage. So they're a company that I think will continue to grow because I think the interest in investing will continue to grow. People will want to and will learn more about putting their money into the stock market and outpacing inflation and creating wealth for yourself long term, things like that. And I think T. Rowe Price is well positioned to have a bright future, which we are going to discuss. So with T. Rowe Price, if we look here, they are trading near their 52-week low. If you look at that chart on the right, they just went under $140 per share. And you'll see here their summary, analysts are more bullish on this than they have been in a while. It's at a 6.4 out of 10. And it's trading at a very cheap PE ratio of 11. So it's fallen massively, and this just shows that this is probably a good point to get into a company like this if you believe in an investment management company. Now, one thing that is very attractive is they pay a very good dividend of about 3.32%. That's $4.80 you'll earn annually on each share of T. Rowe you buy. So a very good I think valuation at this point, a very good dividend. They're at their 52-week low. I've had this on my watch list for over a year now, so it was finally the time to buy in. And one of the reasons why I really like T. Rowe is they have no debt. This company is debt-free. For a company this size, it's amazing that they hold no debt. Last quarter, they're debt-free. This is something that shows and makes me very confident that if they needed to pivot or do something, they now have the funds to do so, and without having debt, they could take out some debt. They could say, hey, we want to take this new venture in our company or try something new, or we want to increase something that's really been performing well and we believe in, and if they have to take out some debt, it's not going to hurt them because right now they have none. That is excellent. That is something that I really, really like about this company. Of course, debt is not always a bad thing, but this just shows that this company has no chains to that debt, and I just really feel that this gives them a great advantage if they want to make any big moves. And now the analysts, of course, are slightly bullish on this stock. It's considered very undervalued. It has a very high quality rating. It has good growth stability, and its financial health is about a medium. So this company, to me, is one that I really wanted to add because my financials sector is something I've really been wanting to boost in my portfolio. Right now, I only have Bank of America and an ETF of the financial sector. Now, Bank of America, just quickly, they are right now currently, they are paying out a pretty small dividend, 1.9%, so that's below the market median. But I got in a long time ago before this stock shot up, so my dividend yield is actually 2.77% on Bank of America, so that's above the market median. So I would love to add to this company. I think they're an excellent company. But for me, they are considered overvalued if you look at an analyst's review. And so they'd have to drop pretty significantly for me to add more because when I bought in versus the prices they're at now, with the dividend yield I'm getting, it would be hard to add to this company. And I'm not super bullish on Bank of America, but it is a very solid bet that I think long-term will provide me good stability. So I just wanted to put that in there. That's not one I plan on buying, but I do want to increase my financial sector holdings. So I added T Rowe, I already have Bank of America, and I have an ETF for the financial sector. So moving on down, we want to, the next stock I might buy in March is more of Facebook. I've made a lot of videos recently on Facebook, but there's a reason why. Facebook has dropped nearly 40% from its highs in a very short time frame because it missed earnings. And I think people are really just focusing on the current quarter and not the future quarters. This is one that I just think, I don't have to show any financials. They're a cash making machine. They have relatively low debt. For me, I think the big hang up with people is that they're not bullish on the metaverse or they're uncertain on it. But let me tell you something. Those Oculuses sold like crazy in 2021. 7 to 10 million Oculuses were sold in 2021. Most of my friends that have kids have the Oculuses. I got to try one out. It was beyond my expectations. It was awesome. And all the big tech companies are now investing in the metaverse. That should tell you something, that this is having a big movement. And I think Facebook will take a huge part in it. And I think people are just focusing on the current instead of the future. So Facebook, I'm very bullish on. I won't spend a lot of time on this one. But I think that in a couple years, I will possibly 2x my money. So that's 50% growth per year. And, Facebook, of course, has some risks. But I think its growth potential far outweighs those risks for me. And so that's what I plan on doing, is adding more Facebook. Next, I want to talk about the next holding I plan on buying in March, and that's more of Vici. Now, Vici to me is just a very solid REIT that I love the idea of this company. It buys, properties for the experiential, experience. So they own a lot of casinos, especially on the Vegas Strip, or they don't own the casinos, they own the land that the casinos sit on. So they get charged rent and collect it. They don't have to deal with fixing up the buildings or anything. That's the problem of, the owners of that specific company, but the land is owned by Vici. So they get to collect the rent from the land, but they have, whoever manages and owns Caesar has to fix up their property. If something breaks, they're on the hook for it, not Vici. So it's a very good business model in my opinion. Now Vici, it's kind of towards the lower half of its 52-week lows. It's got a neutral rating from analysts, and it's trading, I think, at a pretty reasonable and cheap PE ratio of 15.86. I think the potential of this company is set for maybe the next 2 years down the road, where I think it'll really start to grow and take off because they've been doing a lot of acquisitions. In fact, recently, they just solidified their deals on owning the land that the Venetian sits on, the Palazzo, however you say that, and the Venetian Expo. And they also are supposed to close in second quarter 2022 on the deal with MGM Growth Properties, owning the land that those sit on. So Vici is expanding their acquiring, and so of course that's going to affect them now in the short term with the cash, but long term, I think it's going to create a lot of extra cash flow and profits that people, again, I think they focus on the short term instead of long term. And the CEO of Vici mentioned the word global in one of his meetings that I watch, and so I think he probably didn't mean to say that, but it looks like they're looking to expand maybe globally. Now they pay a really good dividend. Their yield is over 5%. That's amazing, and that's one of the big reasons why I like to buy Vici, is not because of its future growth prospects, but it pays such a good dividend now. Long term, you'll be grateful you bought, I think, within this next 2 years. So Vici is just one. I like that it's an experiential REIT. I like that it's something that, with Vegas, people are going to spend money there no matter what. They're not going to worry about a cheap vacation. They're going to go there, and once they're there, they will be spending that money because people pay up for those experiences, and that's just what Vici is all about. So I'll be buying more and adding to this, not heavily because I bought in a decent amount so far, but I still will be adding because it is below my average. After that, my next we'll say holding that I plan on buying is an ETF, and that is SCHD. Now, not much has to be said about this. I made a video expressing my opinion on why I think this is the best dividend growth ETF to buy, and so I highly recommend you watch that. But SCHD to me is just a high quality ETF that owns high quality companies that are very stable, and they have companies like Coca-Cola and Cisco, which I own myself. Now, just because a company like Coca-Cola is extremely large and saturated doesn't mean it doesn't have growth potential. Coca-Cola is aiming to become the #1 seller of energy drinks, even surpassing Gatorade, which is owned by Pepsi. So sometimes I think people see a company like Coca-Cola and they kind of say pass because they think it's saturated and can't grow much more. But I think that could have been said about many companies throughout the history, even companies like Microsoft. So it just goes to show you got to look and analyze for yourself and think about what you want. I don't own a lot of Coca-Cola. I really don't think it's one that I would put a lot of money into, but it's one that I think is very stable and has that growth potential. So with SCHD, you're buying an ETF that analyzes these companies, make sure that they're performing better than their peers, and that they have paid solid growing dividends, I think over like the last at least decade. So this is one that I will always add to, but I do plan on adding now in March. So next down the line, we have 2 more left. I am going to be buying more of 3M. Now this one's a little bit more controversial because it has gone down pretty significantly over the last year. So if you've invested in this within the last year, you're in the red right now. But it is near a 52-week low, and just recently analysts became bullish on this. It has a 7.4 out of 10 score, and it's gotten cheap. It's only at a 14.7 PE ratio, and it pays a really awesome dividend. It's just over 4% now, and it's $5.96 annualized per share. So 3M to me is a company that is going through some litigation risks, right? It has its earplugs issues and a few others that it's going through. But reading many articles, even with those litigation risks, it's still considered undervalued. And with a very, in my opinion, stable company that pays a really good dividend, 3M is one that I will be willing to add to my portfolio in March of 2022. So if you think about it, 3M, where do you see 3M? You see in every hardware store. You probably have 3M products in your home you don't even realize. It is a company that I think is doing things right. And it's recently I had my floors done in my house. I went to Home Depot to buy, the floor protectors for the furniture. Everything's 3M. So just goes to show you that you can't discount this company totally because of the litigation risks and because it's maybe has been a slow growth company for a while, but to me, at these valuations, it's time to get in if you want to hold a company like 3M. Lastly, we are going to talk about Johnson & Johnson. Now, this company of course, is in the healthcare industry, which is one I think always will have a huge future as long as our population grows. And so Johnson & Johnson is one I'm willing to take a decent bet on. Now, they are near the middle of their 52-week range, and they have a more bullish stance of 7.4 out of 10. Their PE ratio to me is decent at 21. I think I'd buy this company up to probably a 24. And they pay a good dividend, a little over 2.5% yield. And so with Johnson & Johnson, what I see with their company is a very solid, stable company that has, it has a decent amount of debt. Its debt to assets is almost 60%, but it still brings in and grows its cash flows. If you look at this chart here, it's grown its cash flows every quarter. So that just tells me that this business is being run really well. And again, debt is not a bad thing, especially with a company that has pharmaceuticals in it. A lot of those companies have to take out massive debt for, research and development. There's a lot of expenses that go on with a pharmaceutical company like Johnson & Johnson. They also have announced that they will be spinning off their consumer products. So they'll mainly focus on pharmaceuticals. I haven't heard much about that recently, but if that happens, I'm totally on board. I think their consumer products have kind of peaked and their growth has slowed down there. So they really want to focus on growth, and they feel that's in the pharmaceuticals area. So I'm okay with this. I think this is a great thing, and actually it caused me to buy more when they first announced this last year. I will say that, Johnson & Johnson has had its own share of lawsuits. So this is very interesting here. Johnson & Johnson, recently with its talc products, a judge said that they can use the bankruptcy system to resolve multi-billion-dollar litigation claiming its talc products causes cancer. A U.S. judge ruled on Friday, signing off on a legal maneuver that enables the company to avoid fighting more than 38,000 individual lawsuits. So Johnson & Johnson used a strategy known as the Texas two-step, which allows companies to split valuable assets from liabilities through so-called divisive merger. In October, Johnson & Johnson, which maintains its talc products are safe, put the claims into a newly created entity called LTL Management, LLC, which filed for bankruptcy days later. So this is very interesting, and a lot of people are saying if 3M kind of can have some success like this, that'll really help that company. But basically, Johnson & Johnson was allowed to spin off their talc products into a separate company and then file for bankruptcy. So that way it didn't affect any other part of its business. And it saved them a lot of money, but it also helps speed up, what rewards can be for the individuals that have the lawsuits. So, altogether, that was a great move from Johnson & Johnson, and the stock did rise after that was released. But, since then, it's kind of gone a little bit back down, but I think this was a great thing for this company to have done. And anyways, I like Johnson & Johnson. I think healthcare has a huge future. As things just advance, we have new innovation and just treatments and so on and so forth, which I think will always be the case. We'll always be having new treatments and vaccines and things like that. So Johnson & Johnson is one that I think has that ability with its huge cash flow to make big moves, to take big chunks of market share in certain areas, and so that's why I'm willing to bet on this company. So that's when I will be buying. So just to summarize, I have a new holding T row, and I will be adding more in March. I want to add more Facebook. I want to add Vici, the ETF SCHD. I want to add more 3M and Johnson & Johnson. So T row to me is a good dividend play, as well as Vici, 3M, and SCHD. Facebook is my growth play, and then Johnson & Johnson to me is a future growth play because they will be splitting off. So I am focusing more on dividend companies now in March than growth, but I still have a little bit of, I have a mixture of both still. So these are the companies I plan on buying. I would like to hear what you guys plan on buying now in March, because with this volatility, what opportunities will you take if a certain company goes to a certain price that you're willing to buy into? I think this would create a great discussion down in the comments, and let me know if you agree with my picks or disagree and why. I'd be very curious to see. and hear about that. And again, thank you guys for joining me in this video, and we will see you next time on Mark's Finance and Fitness.